Welcome to the Dividend Talk podcast, episode 128, the 12 dividend growth stocks for Christmas. Hey guys, welcome back to another episode of Dividend Talk. Today, European DJI and I will talk about 12 dividend growth stocks that we would like to own for Christmas. All that and more. See you on the inside. Hey, European DJI. How are you this weekend?
Really good. It's Christmas, so I'm hoping for a lot of Christmas presents under the tree, and some nice time with the family as well. Unfortunately, the snow started melting, so it won't be an entirely white snow. But yeah, other than that, good. How about yourself?
Yeah, I'm excited for Christmas on my Christmas holidays, which is always nice. It's a nice time of year. We sit down, watch movies, have some drinks, meet family and friends. So I'm looking forward to it. It's a bit different. I know we've had COVID restrictions over the last couple of years, so
Yeah.
I'm definitely making a bit more of an effort this time to spend more time with people and just enjoy the moment, enjoy lots of time with family and friends. So really excited and looking forward to it.
Will you be recommending everyone to start dividend growth investing then at the family?
I'd be recommending everyone to buy Guinness. So so shares of Diageo will be strong. But no, I won't push it on anyone unless I'm asked, which I probably will. And if there's drink involved, probably will talk about it for a long time. But I tend to I tend to not say anything unless I'm specifically asked the question on it.
Yeah, exactly. I have the same. I don't want to be a party pooper by only talking about finance at such dinners or something like that. And anyway, I will bore the hell out of people when I start talking about that.
Yeah, it's bad enough I'm the engineering nerd at every party. Now I'm going to be like the finance nerd as well. So I need to I need to loosen it up just a little bit.
So yeah, definitely. So I listed up. Maybe we can go straight away to the news of the week because there was really nothing worth mentioning, in my opinion. Other than that I experienced quite a crazy week when we look at the S&P 500. That was up and down and up and down. But the fun fact is, like in the end of the week, the S&P 500 is just flat. So it just shows like how important it is to zoom out. I know that on a monthly basis, I don't know, the S&P 500 is 5 or 6% down or something like that. But it just tells you like we shouldn't really watch the share price and everything. But what was really nice, and that's why I'm mentioning it, 3 of my stock orders got triggered. So that's for me really interesting. And it allowed me to buy some additional stocks again.
Yeah, that's nice. I know I mentioned last week that this week was the last week I was going to buy, but I did not in fact get to buy anything. The money is sitting in my account. I did not get a chance to log on. I need to try and actually do what you do and maybe set a price and let it trigger, but I will definitely hope to get on before the end of the year. I'll have more free time now, so I need to.
I just give you an example. I bought some HPQ, which I put a target price, I believe, of 26.25, which was exactly 4% yield. I did the same with Target. I believe I set it at 140, also at a 3% yield. And I did it with DCC PLC on a nice round number of 4,000 pence. So, I like those numbers, right? They need to be a bit round, but they're all like already in fair value zone for me. And for Target dropped 10% for my initial purchasing price, I think 1 or 2 weeks ago. And that's how I usually average it down a little bit in the beginning in brackets of 10%. But I always want to watch out with catching a falling knife. So I never want to buy in too quick in these kinds of stocks. So I'm really having small positions that I added to Target.
Yeah, see, I'm a little bit too impatient for that. So when I log in and I get paid, I want to buy something. I don't want to set an order and then it not trigger. I just wanted to I just want to buy something.
Yeah.
And then what would happen is I would set it probably too low. I go,
Yeah.
penny wise, pound foolish, and then it never gets there, and I get all sorts of
So I don't have that issue really because I have like 8 to 10 buy orders outstanding continuously. Yeah.
yeah.
So, and some are really nearby, others are longer. But it is true if I notice that during the month nothing is being triggered, I buy some of those at the market so they continue to push cash into the market, right? And with that, actually, also I had my goal to invest an average amount per month this year, and I've reached that now in the 12th month. So I can say at least that I've been investing according to my plan. At least this. I said, letting the cash work, and also I still need to run the numbers, but I think also at the yield on cost that I was expecting on average over the whole year. So we'll do the numbers probably next week, but I'm happy with this year and the investments already.
Awesome. It's been a good year, but as you said, we'll push that to maybe next week. We'll round up
Yeah.
our performance and what we've done. So we've picked 12 dividend growth stocks for Christmas. I know you asked me why 12 dividend growth stocks before the show, and I said it's for the 12 days of Christmas. I still don't understand why we celebrate 12 days of Christmas or what it means, but for us, we're just going to give you 12 stocks in honor of those 12 days of Christmas.
Yeah, definitely. And I was thinking about it like when it's a present, right? So I'm not even imagining getting it, but giving it to someone else. Um, you always need to give, I think, a present that someone else would like. Yeah, because if I would give it to myself, I would buy probably again HPQ because I would look at the valuation. But I'm thinking more about people that are not so much familiar with dividend investing yet and would love to start investing. And with in that case, I think I need to look more at foundational stocks, but also stocks with a really strong credit rating and a balance sheet. Because the last thing I want is if indeed next year we will see an economic slowdown, a further economic slowdown and recessions, that they straight away get scared in the stock market. Can happen with some of the picks that I have here. Some are more sensitive than others, but I thought at least a good credit rating, preventing a dividend cut is of utmost important here. And yeah, in that case, of course, I just have to start with Johnson and Johnson. So who doesn't know Johnson and Johnson, right? The iconic consumer and pharma and medtech healthcare business. Already, I believe, 60 years of dividend growth, if I'm correct.
Yeah.
And it's one of those three stocks that has a triple A credit rating together with Microsoft and Apple. Currently, it's a bit high priced at 25 multiple, but don't look too strong at that. I believe if you look at the free cash flow multiple and such, and if you take the one-offs out, it's probably around 17 or 18. This is the thing with some of these stocks like pharma, they have some R&D write-offs and such, and often some one-offs, so it's not always comparable. Currently, it is not meeting my entry criteria yet of a 2.75% dividend yield, but I think as a present, Johnson Johnson just belongs under the Christmas tree as one of those iconic stocks. And with that, they probably get a spin-off in the consumer health business as well. I don't know exactly when it is. I forgot about that. It will be small one. I don't know if they also get shares, but that would also be nice for the person to receive some shares. So Johnson Johnson would be definitely the first present for me.
Nice. Well, you can't go wrong with Johnson and Johnson, really, can you? It's we mention it all the time. It's like clockwork. We know they are changing the company a little bit and they're spinning off, so maybe that clockwork might change. But I mean, over the last 60 years, it's been a company that has kept on giving and giving, and at the minute, there's no reason to doubt them. So that's a solid first choice. I had a similar approach, but not really the same quality. I'm looking at your six, and you really went to the top tier. I mean, I probably couldn't have picked any better six companies, but I went for strong companies in their niche, proven records, most of them except for the first one in terms of dividend growth. But the first company I chose was BlackRock. It's one of the largest asset management companies in the world, and particularly if you want to invest in other types of assets that you can't typically get through your stocks, and they're in private equity, real estate, hedge funds, solutions, all that kind of stuff. We know they're in.
You mentioned BlackRock, but I believe you mean to
Oh,
say
Blackstone.
Blackstone.
That's it,
Yes.
Blackstone. Yes, Blackstone.
Yeah.
So for me, they are, I think, they're definitely top two asset management companies in the world. They have roughly the last quarter that I read, they had 950 billion in assets under management. That's an absolute colossal money. You can see institutions pile of money into these because it's known as kind of stay steady and they generate huge returns over years. They do struggle in a recession, okay, and we think there might be some sort of recession on the way. And I think this is actually a good time to start buying them, start dripping into them. The share price is down at 74. If they get down to 50, I was talking to somebody in chat there over the last week. If they get down to $50, I'm all in on these guys. I think they do really well in recessions, not in terms of their share price. They were struggling share price, but they have lots of cash. That's when they start buying up assets that are getting cheaper that nobody else can afford. And then when we start coming out of recession, that's when you start to reap the benefits of it. The only thing that I was worried about was the concerns about the REIT. Remember, we spoke about that over the last couple of weeks, and they were limiting withdrawals and so on. That's my only major concern around them. But I think genuinely they are a top quality company. The dividend growth is a little bit choppy. And again, they are historical, but if you're to average out the returns over 10, 15 years, their growth rate is up around 10, 15%. So I don't think it's something to be concerned about. And it would be my number one pick this year.
Yeah. So what I see is they probably don't have a dividend policy that is progressive, but rather a payout ratio, right?
Yes, exactly. Yeah. And it's kind of smart as well. I mean, there's no point in them. They need the cash because they need
Yeah.
the cash in these moments to spend on buying, say, private equity or real estate. They need the cash. So it's a better use of their cash to say, okay, we're only going to pay out 40% payout ratio here, but we're going to make that money work a little bit harder in 5, 6 years' time. So
Nice. So maybe I can then actually build a bridge to the next one, because one of the stocks that I would recommend is also BlackRock. It's a position I don't hold at the moment, but here again, I was also thinking about iconic stocks. Who doesn't know BlackRock? Large asset manager, credit rating of AA3, which is really a high grade, currently a PE multiple of 19 and a dividend yield of 2.75. What's important to know about BlackRock, in my opinion, is that they have tripled their assets under management since 2009, but of course this year it started to decline. I think it's about 7.96 trillion at the moment, while it came off the back of a 10 trillion assets under management. So that's, I would say, rapid decline. Makes sense with how the stock market was doing. BlackRock effectively owns the world, so if the world indexes go down, their assets under management go down, of course. And this is important because their management fees, are typically connected to that. We see the same with T. Rowe Price. So this is in the list of 6 stocks. One of those stocks that I would also give as a warning a little bit to family members, saying like, if I would give it as a present, saying like, guys, this one kind of moves with the market. However, the dividend growth rate, our dividend growth track record is pretty decent at the moment with 13 years, if I'm correct, and a 5-year compounded annual growth rate of 14%. The payout ratio of 51% will probably shoot up due to the earnings drop that we might expect with less assets under management. The decent yield, 2.75. I don't see a reason why this company would cut the dividend. They did during the great financial crisis, if I remember correctly, but I don't envision such a crisis coming up. If it does, well, then it does. But I do believe that banks in such a way better capitalized at the moment for a financial institution like BlackRock to be slaughtered by that.
yeah, BlackRock and Blackstone are the two, I think, asset management companies I would like to own, but I always feel BlackRock is out of my reach. It always seems a little bit more overvalued, and price of one share, I can't remember what it is now, but it's always.
$700, but a few weeks ago you could get it for $550. So, I should have done shopping on Black Friday and not on the last moment. But yeah,
it's
you're right.
Do you not find it hard mentally to buy a share for $500? I mean, we invest relatively low amounts, say monthly,
Yeah,
and you don't get what seemingly looks like a lot of bang for your buck, even though you do in terms of yield and stuff.
yeah.
But it's mentally, if you can only buy one share or two
No,
shares,
I don't have that issue, really not. I have this issue more with selling put options.
yeah,
Yeah, it does make a difference whether it's a $25 stock or a $700 stock.
of course it
Yeah,
does.
yeah, because if it gets assigned, then you're talking what is it, 70,000 bucks, right?
A lot of
So
money. Yeah.
watch out with that. But other than no, because I think more in volumes. I think more, let's say, in brackets of thousands. So if I can buy one share or two shares for that, that's fine. I think more in absolute numbers and not in the amount of shares.
Yeah, cool. Sometimes I find it hard, but that's probably one of the reasons why I lean more towards Blackstone than
Yeah.
BlackRock, because Blackstone always seems more within my reach, if you get me.
Yeah, but I think you need to think differently. Let's assume that you have €1,000 to spend every month. For €1,000, on average, you can probably buy 30, let's say €30 of dividends. Yeah.
Yeah,
So that's how I'm thinking. Every time when I put €1,000 in the market, I'm adding €30 of future projected annual dividend income that is supposed to grow. So that's why then if I, because I'm geared like that, I don't really care about the individual
yeah,
share price as such.
I get you. It makes sense. Think in dividends,
Yeah,
not in
you're
share price.
buying income. Yeah.
I know your namesake, the dividend growth investor, does something similar. He always speaks about that as well. So that's
Yeah.
rewiring my brain. That's all I need to do. It's easy.
Of course.
um, the second company I chose is British American Tobacco. I mean, I had to throw a high yielder in there. I think everybody wants juicy dividends, and you get that from these guys. Um, Obviously, there's some concerns. It's a declining business, but I think these guys are really really well run. Warren Buffett once said, "Don't tell me about the economics. I know they're great. You make a product for a penny, you sell it for $1, and sell it to addicts." And that's pretty much what these guys do. They have really, really strong brand loyalty, some really good brands, and then the acquisition then of Reynolds as well really, really helped. Of course, that acquisition added a lot of depth to their balance sheet, which I don't really like, but these guys seem to be managing it well, paying out. They have a really strong free cash flow. I really like them in emerging markets, and also they're in the nicotine and all them kind of marks as well, which is up and coming as well. So I'm not too concerned. Maybe 10, 15 years from now, you might want to start easing out. But I think for the next 10 years, I think this is a company that deserves to be in a portfolio. Really, really good dividends, high yield, decent growth as well. We have to say it's not low growth. So yes, my second company is BATS, BAT, British American Tobacco.
I've done some analysis also on the tobacco stocks, and for me, BTI or BATS, the European ticker, is just the best one of the cohort. And it's really nice to see that their IP was protected in the United States, that they really get to, pluck the fruits from their R&D.
Yeah,
So, yeah, building a better tomorrow, right?
building a better
So,
tomorrow.
talking then about a high yielder, I would definitely buy an insurance company like Allianz. Allianz also credit rating of AA3, again a high grade credit rating, currently at a multiple of 19 and a yield of 5.3. For me, this is also a company that is well capitalized. They had some issues, right, in 2020 where they screwed up and that they had to take an 800 million liability for. But for me, Allianz is, I think, the largest insurer in the entire world. Really
Wow.
large asset management business as well. In Europe, we know it from car insurance, whatever insurance, they usually have it. I think it's also undervalued at the moment, and this one should really give the person that gets the present the feeling of the power of dividends. and they've been growing it quite nicely last year. I believe was it 10% or something like that. So there's still room to grow the dividend, actually quite enough. So yeah, and Allianz also shows a little bit that you can have European companies and you don't need to have American companies for a dividend growth track record.
Yeah, I'm not really surprised you have Allianz in there. You've spoke about them quite a lot on this podcast. They're a top European insurance company. I didn't know they were largest in the world either. But really, really good company, decent dividend history as well. So definitely one for your portfolio. For me, my third one, I had to go. Like I had to go. I'm in automation. I had to pick an automation company, and Schneider Electric is up there as a company that I would love to own. I own small bits inside trading 212 pies, but not really enough. I think it's a really, really strong company. 2.2% dividend yield, decent dividend growth as well. 5-year annualized is around 7%. And we know that they had a big increase then this year, which is about 11%. The two segments that they're in, I'm quite comfortable in. So it's obviously electrification and automation. It's basically my background. They operate mainly in lower to medium voltage. So for you, that's kind of like your house and down. So it's really, really strong markets, strong trends they are, particularly in development countries. That's where they're going to make a lot of noise there. And automation, look, I think automation is going to be huge in the future, and they're really making some waves there. I love the brand. I love using them. As I said, I use them in work the whole time, particularly in automation. So I see a huge future here. Looking at their financials, they have strong growth in top line and bottom line. Dividend history is not too bad either. So I'm a little bit biased, as I said, as I'm in this field, but it's a company that I would love to start owning more of outside of my trading 212 pie. But it's a strong brand and a strong future, in my opinion.
Yeah, what is nice, this company has been on fire, right, on earnings level and such, and at least the price came down a little bit again because it was just so expensive, right? In September, we could get it still for like 10% cheaper than it is today. Who knows, it might come back there again. But even like the PE ratio is now around 23. So, with a little bit
Yeah,
of luck, you can get it for like a 20 PE in the upcoming months, plus a 2.5 dividend yield at that moment in time. And then it's really nice. For me, it's still a little bit too expensive or on the expensive side. But as a present, it's not for us. So it could do.
yeah. No, I agree. It is completely it is overvalued in my opinion, but as a present, I would be happy to buy this for somebody. I think 10 years, I
Yeah.
think this has a really, really strong growth prospects over the next 10 years.
Yeah.
I really do.
Or to get it, of course, as an engineer from your family. Yeah.
Exactly. Yeah.
When we are then in the engineering side, it's maybe not entirely engineering, but let's make a jump to the chip industry. And my fourth stock that I would buy as a present is Texas Instruments. And who doesn't know this company of the calculators? It's still building and producing those really great calculators that everyone loves. The issue with that is there's not a large replacement business for this because we still get sometimes pictures on social media from people that were using this calculator 30 years ago. But luckily, they diversified over the last few decades also into the analog chip business, right? And it's just a cash flow machine. And I think this is also really important. Here, you can really make a nice poem also for the receiver of your gift around the power of cash flow. I believe they have annualized free cash flow growth of 14% over the last decade, 2 decades. Balance sheet or credit rating AA3 again, just like BlackRock and Allianz. A PE currently of 17, which is for me really attractive for a company like Texas Instruments. We know that the chip industry is, under pressure. We see it with lots of those stocks there, supply chain issues, fear for a global economic slowdown. I think those are all valuable, but currently at a yield of 3%, and I find the dividend really, really safe. So I don't see a reason why this dividend can't even grow. So in my opinion, Texas Instrument is a good good choice as a present. Payout ratio of 46% at the moment. And yeah, dividend growth rate, I believe, of 17 years, or dividend growth record. So, and let's not forget, even the dividend growth increases over the last 5 years, about 17%. So that's, of course, really rapid.
Yeah, top quality company. I know we speak about these all the time. It's funny. Everyone calls them just a calculator company, but what they've done in the market is sensational, and particularly in around dividend growth and over the last few years. And do you know, a PE ratio of 17.3, that's fairly good as well, to have to
Yeah,
say.
exactly. So I've been accumulating this year in Texas Instruments, really happy with my entry position. And I hope I can continue to do so next year, right? Not buy everything at once, but like every month or every 2 months a little bit.
Yeah, nice one. I stayed within my engineering sphere, and my fourth Christmas gift to somebody would be Siemens. We've done a whole show on these guys. We know what they're like. 3.3% yield at the minute. They did have that little blip where they cut the dividend 2 or 3 years ago, but I think it's a fantastic company. Honestly, I think it's a European powerhouse. I think it's one of the best companies we have in Europe. Um, I don't need to talk too much. I will maybe direct you to our show that we did on these guys. But Siemens probably be number one for me, and I'm so happy I bought them back there a couple of weeks ago as well. Just when they
Nice.
got to about $100. So
Yeah. And we know it's a cyclical
Euro.
company, right? So I'm somehow hoping that it would go to $80 or something like that in the next crisis, because then
Yeah,
I'll have to buy it.
we're saying dollars, but it's euros. It's a European
Euros,
company.
yeah, sorry.
Yeah,
80
I said
euros.
I said the same. I said the same.
Yeah.
But I mean,
Nice one. Nice pick.
I was doing the same. I was waiting for them to get to 90,
Yeah.
and then they got to 100, and then went up to 110 and came back
Yeah.
down. I was like, as soon as it came back down, I'm going back in. But
Yeah, what is nice with this one is that if you give this to your family in Europe, many people will see the brand. They will see the brand, the logo on the windmills when they are sitting in a Siemens train, right? Going through the landscape by train, a Siemens train. They will see the Siemens probably signaling as well on the railway, and
yeah,
they will see the windmills by Siemens. It's like everything industrial around you can see as Siemens. So that's really nice. Okay, so then for me the fifth one, yeah, that has to be Shell. And specifically, I would give that to a person in my family that would be on the woke spectrum, because if they think that oil is dead, I will show them it's not. And then I will also tell them a story about how much clean energy they've been buying and how much they're investing in projects, just also to work a little bit on the development of the wokeness poison that they got, because I will make them realize that they are taking the car everywhere. They want to be on Ibiza partying or somewhere. Going to I know Switzerland for skiing. They use airplanes for that. So I will tell them that if they buy enough Shell, they can self-fund all their travel, and don't worry, because it's transitioning with them into a new world of clean energy. So that's this gift would be more educational, I think. I might piss them off on the short term, but investing is a long-term game, right? And yeah, we don't look at the emotional volatility with them. At the moment, it's you get it at a 5 PE, but this says nothing for cyclical. They are always having a low PE on the top of a cycle, which is now. But the 3.5% yield, if you look at it from a valuation, it's probably a little bit on the high end. You could buy it now. But as a gift, I think it's just a decent stock to give as a gift.
yeah, and as you said, educational. I love that.
Oh, yes.
So my fifth company, I went a little bit different here. It's a small cap, well, 12 billion market cap it has. So a company we've never spoke of, but I was looking at the dividend history, 45 years dividend growth, 5-year growth rate of about 13%, and payout ratio is really low, it's 12%. So the dividend for me is really, really safe. So given the 4 decades of paying dividends, I said, okay, these guys deserve some attention. So they are called Carlisle Companies, ticker CSL. I don't know if you ever heard of them. So they're into like construction materials, roofing. They supply
Mm,
cables, wires, fluid
okay.
technologies, brakes and frictions, all that kind of stuff. They're really heavily involved in M&A activity, which has drove a lot of their growth over the last 10, 15 years, which obviously we know has some upsides and downsides, but they seem to be able to do this seamlessly. They are really, really good at getting rid of companies or parts that are not functioning very well. For example, they had like a food division and they said, nope, this doesn't work, got rid of that, and brought in this higher growth business and brakes and friction. So decent company, really strong balance sheet as well, which I like. As I said, low payout ratio, strong dividend history, and strong balance sheet. So for me, this would be a gift I would give. What I would say is that they do seem a little bit overvalued right now, but
Why? Yeah,
well, in terms of P/E ratio and their yield, they have a low yield. I would much rather these at about 2.25% dividend yield.
yeah,
But they will, if we have a recession, they will struggle in terms of share price in that period. Um, but I would like to own them at a 2% yield. 1.27 is just a little bit too low.
yeah. But they have also hardly any payout ratio, right? So 45
Yeah,
years and a really low payout ratio. So it's currently trading, according to my data, the PE ratio 14. Yeah, so this company can hike the dividends to the tits if they want. And if you look at it, right, in the great financial crisis, it was trading at $21 and now 237. You're talking about 10 bagger here. You
yeah,
know,
and
oh,
the predicted return over the next five years is $400 or $450. Like so, I mean, I think it's a gem that I've only
yeah,
really discovered over the last couple of weeks. But it looks like a really really good company to own. As I said, the only thing is that dividend yield is just a little bit too
yeah.
low, but the growth rate is
Yeah,
more
I
than making.
think you don't need to worry about the dividend, I said, history. And I think the last time they hiked their dividend with, what is it, 40% or something like that? Yeah, they
Yeah,
brought it from 4 cents to 75 cents.
yeah,
Crazy.
yeah.
Nice one. Nice one. Really nice pick. I had never heard of it. I need to look into it and see what I want to do with that one. Okay. Hey, the last one then for me is, I mean, this I just have to give. It's a low yielder, 1.14%, AAA company, credit rating, Microsoft. I just have to give it. P of 25. I mean, I've spoken a bit more about this. It's after Shell at the moment, I believe my largest company position size in my portfolio. I hope I never need to buy it. All companies go bust one day. I just hope not in my lifetime. But if you look at their whole ecosystem, their business, it's on fire. And with such a company, and actually currently more and more getting attractively valued again, I mean, who doesn't want to have a share of Microsoft on the Christmas tree? I mean, for me, it's a perfect holiday gift. So I had to end with this one. Maybe not really to demonstrate the dividend growth, because they will look at the checking account and think like, oh, is that it? Um, but yeah, if I would give them a basket of the 6 stocks that I discussed today, so J&J, Allianz, Shell, Texas Instruments, BlackRock, and Microsoft, this basket is giving you a 3.05% dividend yield, which I think is really nice. And all these companies together give you also double-digit dividend growth. Yeah, like 10%, 11%. Um, so I think this is a really strong basket to give someone as a present with strong credit ratings.
Yeah, you'll see me checking my phone there because I saw something today in one of the groups. I just read it in passing, but there's talks of Microsoft acquiring Netflix next year. It's
I
on
saw that
on
as
the
well.
radar. Yeah, so
Yeah,
that's quite interesting. Everything they do turns to gold. So it'd be
yeah,
interesting to see if this is actually. I don't know if I like it, honestly.
yeah,
But it's interesting to see.
yeah, yeah. Nice one.
Cool. So the last company that I had, I really wanted to pick an Irish company. I really did. And you've heard me talk about Smurfit Kappa before. It's a packaging company. And honestly, when I was looking at it, there is a better option out there. And it's a company called Sunoco Products, ticker symbol SON. I don't know if you've heard of them. They're Dividend aristocrat. They've 40 years of dividend growth, really low payout ratio of 30%. And their dividend yield is much better. It's 3.28 as well. So they're in the packaging industry. What I do like about them as well, that they've recently took over Ball. You know Ball, they make the cans. They make all the
No.
cans for Coca-Cola and stuff like that. So they do really well with buying these types of companies. Really strong company. What I like also is that they can pass on most of their costs to customers because they're in the packaging, and most of their customers are like the likes of Coca-Cola and all these like industries and so on. So strong company, really good balance sheet, good acquisitions, particularly Ball. I like that one. And that's my pick. I did really want to put Smurfit Cap in there, but these guys for me is a much better option. And if I was buying a gift for somebody, I would prefer to give them this over Smurfit Kappa.
Nice one. I never heard of them. And this is an Irish company because they trade in the US, right?
These are not Irish. Smurfit Kappa
Okay.
are the Irish version. These are just
Okay, that's
a
what you
better option.
meant. Yeah,
Yeah,
yeah. Oh, nice one. And actually, this looks really, really good. I see that they were able to hold up their dividend, although just, with a really token hike during the COVID crisis.
yeah.
But other than that, it looks good. Not so much an impressive dividend growth over the last decade, but they're definitely making it up over the last year for that. Nice one. Nice.
Cool. So I think that was the last one. That's our 12 dividend growth stocks of 2022. I did try to mix it up. I kind of guessed you were going to go with some of the big guns. So I tried to mix it up and throw in some that we don't really speak about on the
Yeah,
show.
that was nice. Nice. Good.
Awesome. So we have a portfolio review, and then we have a ton of questions. So we'll try and get through these as fast as we can. The hobby investor sent in a portfolio, and he's got 14 stocks here. Top positions are Johnson Johnson, ASAML, Vici Properties, ticker VICI, or Vicky, I don't know how you pronounce it.
Mhm.
Realty Income, Procter & Gamble, Texas Instruments, Target, and Pepsi. What are your thoughts on his portfolio?
Wow, really strong, really strong. And it's so funny. He says literally like, feel free to be as hard as you guys want on me. I'm a happy listener and the goal is to improve. But look at this portfolio, right? 14 stocks, pure quality and nicely diversified, really nicely built up. I mean, I can learn from his portfolio, to be honest, instead of the way around.
we were laughing, like we read that, be as hard as me, be as hard as you want on me, and I was like, I don't know what I'm going to say here. Like, it's
This is
there's not
such a strong portfolio.
there's not one company there that I would say take out. He has seemingly the right percentages in the right companies as well. To me, I would just keep going as you're going. You'll probably have a stronger portfolio than I have,
Yeah,
to be honest with you.
yeah, exactly. This is such a strong portfolio. To have your positions anchored around Johnson Johnson, ASML as your two top holdings. I mean, this is quality. So, of course, ASML brings the yield down, but he has other companies to compensate for that, like ASRNL, T. Rowe Price, Ahold Delhaize. So he has enough compensation for that. So the mix of this is also really, really, really nice. And a hobby investor, we really have nothing to recommend. I rather need to study yours again a little bit and see, like, can I learn something from this to avoid another Castellum with a CEO that, yeah, full of shit of himself.
Maybe the one thing is he does have Tesla and Google. Maybe look at getting rid of Tesla. That feels like it's a bubble that's about to pop. It really does.
Yeah, but I think it popped already. But he also explains that, right?
I know, of course. I know
Until
what.
2, 3 years ago, he was investing in kind of everything. But then around June last year, 2021, he really started to focus on dividend growth investing and adjusting his portfolio now. But looks really awesome.
Good job. Good job. So listeners' questions. We'll try and go through these as fast as we can. We have quite some to get through. So Loic, I think that's how you say the name, has asked our opinion on Rubis, ticker symbol RUI.
So maybe for the listeners, Rubis is a storage facility for petroleum, liquefied gas, these kinds of things. So for me, the Dutch equivalent is Vopak. They have about 25 years or 20 years of dividend growth and it's currently yielding 7.5%. It's listed in France. So my issue just with this company a little bit is that if you just look at it from a pure share price point of view, it was $60 5 years ago. It's now $24. So you lost a lot of capital, let's say, from that point of view. But it continued to grow its dividend over time. So it's also really a multiple compression from one end because it's currently on a multiple of 7.6. I find it really, really hard to understand what to do with this company. So on one end, ticks the box on the dividend growth, really nice, really high yields. But when I just look in a bit into the numbers, also the free cash flow payout and such is really high. I think it's not covering the dividend. Then it feels like it has all the warning signs of a dividend safety issue. Yeah, so that's why I would not invest in this company in Rubis, an iconic French company, and rather look at Vopak instead if you want to be and want to own a piece of this industry.
Yeah, it's quite strange. I don't know a whole lot about the company, but given what they're in the storage and sale of petroleum, liquefied petroleum and gas, I would expect them to be doing quite well over the last
Well, they
12
actually
months.
do well typically when there's an oil crisis, yeah, because then oil is cheap and such, you can store it. So it's kind of a hedge towards Shell, if you want to see it like that, like Vopak as well. That's how I look always at these companies
Yeah.
here. But yeah, I understand why you're looking at it, Louis. But please watch out for a yield trap. That's my concern, although I haven't done enough research on the stock.
Cool. Omar has asked us about our thoughts on FlatX, the hero at its current valuation.
Yeah, so I'm not interested in owning that stock at all, but I think the question behind it might be like the stock has crashed, really, really crashed hard. Also because the German authority, gave a, what is it, a reprimande the other time to Flatex. They found some serious issues. Stock got slaughtered with it. So, and what I think about that is like that's the reason why I have my shares at the Hero, Interactive Brokers, and still some Saxo Bank and Trading 212, because I'm also diversifying across brokers. I don't want to have all my wealth in this at a single bank or broker, because you never know whether you're dealing with an FTX, right? Where they say that your money is separated, and in the end they're just
Yeah, screwing
doing
you
all
over.
kinds of, yeah, exactly. So the good thing is that this is I said this is a industry that is all the time being how is it controlled and audited by the regulators. That's why they Flatex is getting a reprimande. So I let this industry do its job and the regulators do its job, but I'm not interested at all in owning a stockbroker, no matter what kind of stockbroker.
They don't pay a dividend either, so we'll move on.
Yeah.
Marek has asked us, what do you think about the Sharpie ratio used for stock allocation in portfolios?
So maybe for the listeners, the Sharpie ratio is actually one of those methods you can use for measuring risk-adjusted relative returns, and that's already a mouthful. You always hear economists talking about this in some of those general stock market podcasts, and then they look at the Sharpie ratio and such, and they say, "Oh, the market is overvalued or undervalued." In the end, it's for me a lot of academic gibberish. Hence, I don't look at it at all. I don't invest in the stock market because it's a market of stocks, not a stock market. So for me, that's why I'm really not taking these kinds of things into account.
Cool.
Sorry, Marek.
Casper, Casper has asked us a couple of questions. The first one is, you talked about a Dutch insurer recently. What about PZU? I take it they're like a Polish
Yeah,
insurer.
Polish insurer. This is where patriotism and home bias comes into place, right? So I have looked at PZU several times because I only own Ambra at the moment. Of course, I want to own few more Polish stocks. I hear a lot of people talking about Dino Polska. It is on my list to further analyze, but I first need to visit their shops. But let's get back to PZU. Currently, 5.6% dividend yield with a PE of 10. Actually, just a month ago, you could get it for like 30% less because I had a 25% run up since then. So that would have been a nice juicy yield. But unfortunately, its dividend is just not growing over time. It is really choppy. Dividend cuts here and there. The dividend policy is just not supporting such kind of I said from what I know, progressive dividend policies. So hence, that's why I'm not interested, because as I always say, I need to be able to count on my dividends under the utmost stress. In the next crisis, I can have two, three companies cutting their dividend by half or maybe even entirely. The rest of the portfolio will need to lift it up. But to be in such a situation, I need to make sure that I buy companies which I think none of them will cut the dividend, because two or three will be in the blast zone. So that's why I'm not interested, unless, and I've got one or two exceptions, and those are Rio Tinto and BHP. But I didn't buy them for the dividend growth, just for the high yield, knowing that they will be cut at a certain moment of time. And PZU is for me not an equivalent to BHP or Rio Tinto.
Okay. A follow-up question of that is, what's your take then on companies where governments have the control and stake?
That depends on whether the companies and the government align in their incentives. Yeah, so for instance, there are some utilities that are attractive, that pay a handsome dividend, are in a growing industry, maybe, where the government also has a stake. If the government, for instance, depends on the dividend income as well to fill the income gap, then I think that's fine. Preferably not, but yeah, I'm not like binary in this.
Yeah, yeah, I'm quite similar. I don't. It depends on the industry, depends on the company, as you said. If it's aligned and doesn't affect the dividend, I'm all for it. The third question I'm actually interested in, because I've seen this floating around. Have you tested the US ETF buying on Interactive Brokers?
No, but someone else tested it today. So I saw it on Facebook, in our Facebook Dividend Talk group. The link to the Facebook group, if you want to join, is in the description below. That's where you hear these things quite quickly in the first. But someone tried it out and seems to work. So what you can do is, if you go to Interactive Brokers and you look up the ticker symbol SCHD as a European investor, you will notice that there is no buy button. But what has been added lately is recurring buy. So automatically investing every month, for instance. And this button seems to work. So I don't know if it's a bug or a feature, but with this, yes, it was confirmed today by a Spanish dividend investor that you can configure this and actually start buying SCHD ETFs. If I'm going to do it, I don't know yet. But now that this option is there, I will seriously consider maybe, 100 bucks a month or something like that would be nice.
I'm skeptical. It's definitely a bug. The rules haven't changed overnight. At least we would have heard about it, but I don't know what will happen if it is a bug and they realize it's a bug. Will you be forced to sell it? Can you sell it?
I don't
What's going
think
to happen?
so, because you can also do the option trade and get some shares assigned. And Derek, come on, in the spirit of Christmas, you don't watch a gift horse in the mouth. Yeah,
I'm I'm just too skeptical. I'm just too skeptical with it. I mean, it just doesn't make sense that you can't buy it, but you can buy it on a recurring. I
yeah.
know the options don't make sense either, but for me, it just seems like it's a bug, and maybe we shouldn't spread the word on the podcast in case it gets to too many people and they shut it down. But
Yeah,
um,
if someone from Interactive Brokers is listening, please don't do this to us. Don't tell it to your colleagues. Just keep it as it is. Ignore it. You do the whole European community a favor with this.
okay, Tim has asked our opinion on mining stocks for dividend growth investors with a fairly long time frame. I mean, I don't know the industry well enough. If you know that industry and you know the companies and you have a long time frame, I would have no problem in doing that. But again, as someone like me that doesn't know that industry, I I would say not stay away, but I think you just have to understand what you want, particularly if you're looking at a longer time frame.
Yeah, nice one.
Mike, Christmas sweater or a whole sweater?
Yeah, Mike was with us on the show last week. It was really good, right?
Yeah,
He was
it
good. Yeah.
was a great show.
I would always go for Ahold sweater. Of course, I got it for free.
I, yes, that's a great answer. I will be wearing a whole sweater for Christmas, 100%.
Then maybe
Um,
Tim N, and he asks if we have any thoughts on Columbia Sportswear with ticker symbol COLM. He mentions that it's a 5 billion outdoor brand with three other brands, quite similar metrics to Nike, except they don't have any long-term debt.
I mean, I know the brand. I've seen the brand. They did cut their dividend, and I'm always hesitant in these types of companies. I think Nike and Adidas are probably two exceptions, maybe. So I'm always expecting these types of companies to cut their dividends in any form of turbulence that we go through, like COVID, financial crash, anything. So I'm always hesitant to get involved with these types of companies.
Yeah, same here.
Next question is from Nick Scott. Which purchases are you happiest with this year and why?
Oh yeah, Texas Instruments. I was looking at this company for so long, and finally I got it. Such high quality.
Yeah, Texas Instruments up there. Siemens are up there for me as well. Particularly when they came back down, I thought I missed the chance, but those two for me.
Nice one.
Life with dividends, 2023 goals. We'll speak about this next week, I think.
Yeah, exactly.
Yeah, yeah, we'll do that next week. Tiago has asked us, would you ever invest in special situations, i.e. distressed companies, bankruptcies?
No.
Fuck no. I don't have enough experience to do any of that. You're crazy.
No, it's like buying FTX at the bottom, thinking that that the only way is up.
Honestly, I think you'd have to have some inside information, and even at that, I'd feel like I'm pissing my money up
Yeah.
against the wind, and so I I wouldn't.
I'm envisioning now this gold shower that you would get, like salty rain. Come on.
um, Herman has asked us. There's these new tax rules introduced for publicly traded partnerships (PTPs). For non-US citizens, they have to pay an extra 10% tax after selling from 2023. Is it still worth keeping these positions with a time horizon of 15 to 20 years?
For me, not. And I tell you, this is theft. Yeah, this is just criminal what they're doing. What they're talking here about this 10%. It's not 10% on capital gain. It's 10% on your total sale value next year. So if you sold for 10,000 worth of shares, let's say with a profit of 2,000, you would pay 10% over the 10,000, not over the 2,000.
Wow.
Yeah, this is just criminal. So I would never, I would never participate in that. I would sell them before the 31st of December. It's not worth it. It's really not, really not worth it. I mean, 10% sale tax. Yeah, that means you need to have a 10% yield at that time to make up for that in that single year. It's insane. It's insane. I would never participate in that.
It's a lot of money. If you already own them and you have a 10 to 15 year or 10 to 20 year horizon, look, nobody knows what's going to happen in that. It could reverse, it could double, it could do anything.
Yeah, but
It's
let it
just
grow to 30,000, becomes 3,000
yeah.
then. So how much can you collect in dividends over those years?
But I mean, the tax rules could change in 20 years' time. We don't know what will
Yeah,
happen in 20
yeah,
years'
of
time.
course. I
So
mean, he could
it's
also hit a truck and be dead by then.
yeah, it's
Yeah.
it's an absolute it's a risk. It is a risk,
Yeah.
but it just depends. For me personally, I would think the same. I would be looking to exit. I really would.
Yeah.
What is your fair value estimation on Microsoft? That's from
So I
Jason.
haven't done it lately, but last time I checked, it was around 250. So it means like it's slightly undervalued right now, but I want to buy such a company at a discount. So if let's say that around the $200, I might definitely consider nibbling into some shares again. Although the yield is not good enough.
180. I told you on Price Anchor. I mentioned this last week.
You're anchored like a Titanic.
Yeah, I'm stuck. Future dividends. What kind of companies go in your too hard pile, as Buffett would say? Mining companies.
Uh, Pure biotech. And
Yeah.
I understand a bit of biotech, but the issue is the science. So I'm not talking about big pharma. I'm talking about pure biotech here. The science is so advanced. I don't understand it.
Sometimes even pharma can be put in there because they talk a lot about pipelines. And let's be honest,
Yeah.
unless you're a chemist, a pharmacist, or a scientist, or whatever, you're probably reading half of these and not knowing
Yeah.
what they are, are they any good, what they mean. You know they're in phase 1, 2, 3, or they're going to market. You understand
Yeah.
that, but you have no idea what's going on behind. So
But big pharma is more about portfolio management, right? Most of their pipeline is in licensed or other deals they make, acquisitions. So it's more about portfolio management. And they might have like several products, let's say diversified portfolios, not all expiring at the same time. So you have enough time to evaluate management's portfolio and capital allocations decisions. But if you're going for a biotech, which is kind of like a one-trick pony, you need to know the science. So that's for me really a differentiation here.
yeah. Dividend Yogi. So he's given his outlook for 2023. He thinks inflation will come down strong and fast, lower commodity prices, energy prices, fading supply chain. Recession won't be as bad as what we think. And what was he saying? And stocks will recover in the end. What's our opinion on that?
Yeah, it's good. It also couldn't. Yeah,
What do you think?
so I think that we will see a consumer recession. Because I just see it in the people around me. I think people are now, consuming their savings at the moment, and those will dry out at a certain moment. Um, that's what I'm expecting. I don't expect it to recover so quickly. I think this impact, because usually like interest rate hikes, they come with like a 6 to 8 to 9 months delay into the economy, if you look at it historically. So he might be right, but I'm a bit more pessimistic when it hits the consumers. Although at the same time, it doesn't mean necessarily that the stock market will be impacted by that, because some of that might be priced in already.
Yeah, I'm not so sure it'll recover as quickly as next year. Like you, I do think there will be a recession. How bad it will be, nobody knows. We might not even have one. might,
Yeah,
might not even
exactly.
have one, but I don't expect it to recover. I really don't. So we'll
Yeah.
see. It's hard to know, but it's a good synopsis he gave.
Yeah. Then Mikey is asking us about how our bromance started and why did we start the Dividend Talk podcast. That's a nice question. We haven't had that one for some time.
Yeah. I mean, we met on Twitter. We spoke online. We just came on to chat. thought, hey, look, if guys like us want to sit here talk for I don't know what it was about 2 or 3 hours about dividends,
Yeah.
surely other people might want to listen to it. So we started a pilot episode. Remember that pilot
Yeah.
zero, just in case it was rubbish. And
I remember like how it went. Yeah, it was so funny.
it was we normally, like, when we record, it's always one take. We don't
Yeah,
really edit anything out. It's all straight. And that first one we must have edited about
like
50
30,
times.
40, yeah, 50.
It was crazy.
Yeah. Then Miss Coffee Break is asking if we always drip, and I assume she means dividend reinvestment here. And yeah, are you doing that? And thank you, by the way. She congratulated us for the podcast. Have a Merry Christmas, Miss Coffee Break.
Yeah, see, I don't have the option to do that. The
Yeah,
Hero or Interactive Brokers don't allow us. The only thing as close as that is on Trading 212, you have to pay and auto reinvest it
yeah,
on. That I do.
yeah,
If I had the option to drip, I would, not in all positions, but I certainly would with some of my top
yeah.
positions.
Maybe it's good to know for our American listeners. Like you can usually only drip in stocks where your broker is located. That's why Interactive Brokers, we can drip UK stocks, yeah, like Shell and Unilever. On a Dutch broker, you can usually drip Dutch stocks. So it's not really a wide available option to us for that reason.
Okay. Did not know that. Interactive Brokers are actually headquartered in Dublin as well. They have, so I wonder if I
Yeah,
could drip with Irish stocks. I'll check it out.
yeah.
Jesper, what metrics do you look at to determine how much a company will grow for the next 5 to 10 years?
So it's not so well. Okay, first of all, I look at let's. I'm talking here. I don't know if he's talking about dividend growth or just generally bottom line growth, right? Because if it's dividend growth, I look at the payout ratio and such, yeah, and the balance sheet strength to determine dividend growth. If it is about, let's say, net income growth, I'm actually doing more product review. I try to understand the products and services the company is selling. I try to get a feeling for the market and whether, for instance, their historical performance can be extrapolated into the future or not. So it's more like a business analysis that I do, and that's not really based on metrics.
Yeah, it's hard to know if you're talking about dividend growth or how the company will actually physically grow, where you
Yeah,
think the growth's going to come from, and a lot of that is, I would say, guesswork. If you're being honest,
it is. It is. Yeah,
educated guesswork. But for me, I'm going to assume it's the company growth, and what I like to see is a competitive advantage. I mean, Warren Buffett has talked about that, but that's what I would like to see. They have at least one, preferably two, competitive advantages that sets them
yeah,
apart from their competitors.
exactly.
Um, that's what I look for. Keep Walking has asked us a question. I don't really understand this question, so I'm going to ask it and see what your thoughts are. But it says, can you explain more the origin retentions for dividends in the European countries?
I have no clue what it means.
Yeah.
So keep
Um,
walking. Please ping us and let us know what you're trying to say with this. I'm not understanding whether you're talking here about dividend withholding tax or something like that. Yeah.
Okay, and the last question then is from Doris. What is the best Charlie Munger quote?
For me, it's opportunity comes to the prepared mind.
I like where he says, those who keep learning will keep rising in life.
Oh, deep, deep,
It is
deep.
deep. It is deep.
Nice, nice, nice.
Awesome. We got through all those questions. Thanks a million to everyone for the questions. There was a lot today, but we did our best to get through them as quickly and as give as much information as we can, I suppose.
Yeah, and I hope that we kept you a bit busy during the Christmas days. I can imagine sometimes it's boring with the whole family. So I hope that this kind of long hour kept you a bit inspired and didn't bore the hell out of you as an alternative.
And with that, I think we both would like to wish you all a happy Christmas and we will see you with one more show before the end of the year. I
Yes,
hope.
let's do it. Let's do it.
See you on the outside.